The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
Hi, and welcome back to another episode of the Multifamily Masterclass. I'm Bart Deal, and today I'm joined by our two amazing guests, Jamison Manwaring and Heidi Butler. We got two great topics we want to talk about, and they're hot topics. If you watch the news, you're on X, you'll see this is a common topic. First one is market volatility versus real estate stability. And the second topic is tariffs and their effect on multifamily. So the first thing I want to dive into is an article from Fidelity, and it was titled The Fear Index. So the CBOE Volatility Index, also known as the Fear Index, measures the market's expectation of volatility in the S&P 500 index over the next 30 days. It's a forward-looking gauge, so not a measure of past volatility, and is calculated using the prices of S&P 500 options. A higher volatility index generally indicates that investors expect a more volatile market, while a lower volatility index suggests a lower expected volatility. So we'll put the chart on the screen, and you can see that in March, it's reaching a really high high. You know, it's almost doubled since February. So my first question to Jamison, the VIX, the volatility index, investors are clearly bracing for more stock market volatility. What factors are causing this volatility in the market? How do we react?
There's basically one factor that's causing all of this right now, and that's the new administration, and specifically right now the tariffs that have gone out over the last 10 days or so. We're sitting here the 14th of April, and on April 2nd, the new tariff regime kind of came into play. And it was a lot higher than what most people in the market expected, meaning that the tariff amount was a lot higher than what they thought. Some people even thought it was only a way to negotiate with foreign countries, that it wasn't actually going to come into play. And so you immediately began seeing, as those tariffs were implemented, we saw a huge drop in values across the board. We saw people moving assets from American-based assets to other international companies. For a while, we saw the 10-year bond that there was what they call a fleet of safety from equities to fixed income or to treasury bonds. And then that didn't last forever. And a few days later, the bond market started being impacted and bond rates started going up, which is what we didn't want to see. So yeah, this has been a lot more volatile than people were hoping. People in the business world who I think continue to believe in some of the main policies of the new administration, mostly lower rate regulation, lower taxes. That was really the promise. Tariffs weren't a big part of the campaign. A lot of people during the campaign who supported the president said that tariffs probably weren't ever going to actually happen in a large proportion, that it was more of a negotiation. Yeah. Even though there were tariffs in his first administration. And now what we're seeing is, no, this is coming into play big time. And if you look at the VIX, the chart here in January and February is pretty stable, but it's had a huge spike. Investors don't like uncertainty. We don't like not knowing the rules of the game. Yeah. Markets don't like knowing the rules of the game. We don't like not knowing what's it going to cost to import. I mean, some of the people who I know who are in the business world and who sell products, they're just in a state of unknown as to what am I ultimately going to be able to buy my product from China or another country that comes to the U.S. and sells to a consumer. They just have no idea, and so that it's the market tends to be forward-looking, and it takes into account a lot of what people are experiencing. But if you're really running a business and you get your product that you sell in the U.S. offshore, it's a really rough time
Yeah.
to be in that
A
business
lot
right
of
now.
uncertainty.
Now, thinking about that overall, is the uncertainty, especially with our administration, in his plans with tariffs, or, I look at it, it's the uncertainty because of the modifications he's making to his plans. He goes out with a plan, we're making tweaks to what we originally said, and that's really leading to the uncertainty, not necessarily the tariff, the initial plan, but the modifications, the changes, the pauses. Are we coming back? Is that what you're seeing as well, or is it just his original plans are scaring people?
Yeah, and I think that's definitely a part of it, is not knowing exactly what it's going to be. But I know currently, right now, today, China's the one country that has the highest tariff, and they're it's kind of
125%.
isolated,
Yeah.
125%. And so, and then there was a reprieve on electronics over the weekend, but then it was some clarification that just said they're going to have their own tariff. It won't be 125%. But I think people kind of expected that, because it is a big part of this is the negotiation.
Mm-hmm.
But I heard someone who was manufactures clothing, sell the clothing for $150. If you are in that business, you have to buy that for about $30 at wholesale to be able to sell a pair of pants at $150. And where the tariffs were for that manufacturer, and they get some cotton from the U.S., they send it to Vietnam to get milled. Then it comes back to the U.S., and there's a several step process, but their cost now was going to be about $150 for the cost, so they would have to sell this pair of pants for $450,
Yeah.
and it just was not going to work. It doesn't appear that there's going to be a change, across the board, that the tariffs are going to be gone. That's not going to happen at this point. I think everyone knows they're going to be there. So a lot of businesses have to now go work this out to see if there's even a business anymore. Can you have a clothing business that has to make all the clothing in the U.S.? It's really tough, because it's $1.50 per hour in Vietnam for that labor, and here it's $15, $16 for the labor, and so it just makes it really, really tough.
We talked a lot about the effect it has on business, but as an investor yourself, how are you navigating market uncertainty? Are you diversifying right now? What's that look like, Jamison?
Well, we talk to a lot of investors as well, and we get a feel for what people are doing. I know some of the investors we've talked with that are bigger investors have pulled their money out of the market. We talked to one investor about 30 days ago who just had this uneasy feeling, and luckily pulled a bunch of money out of the market before all this happened. And they were investing in one of our projects, so I knew the timing, and then had a conversation with them a few days ago, and they were quite happy of their timing. But it's impossible to time the market. But I think that if you are invested, you just have to ride the wave, because you can't time this. You don't want to pull your money out now, because you don't want to bring all of your money out. But you want to maybe say, well, let me change my exposure a little bit. Let me change my proportion of higher risk investments.
Yeah.
And then for us as a real estate investment company, we think in our industry the next few years are going to be very good when it comes to rents and rent growth. Housing continues to be very expensive if you're going to buy a house. And so you're looking for opportunities of where can you put capital that you think are going to be good over the intermediate term, 2 or 3 years, and you just have to stay invested. Investments struggle. They're not always going to go up and to the right, and that's never been the case and never will be. So at this point, you just have to test your determination a little bit.
Yeah, and I feel like for the investor that is maybe a little bit more worried, they want more conservative returns. This topic is called market volatility versus real estate stability. So, real estate's a great asset. It's fixed. Although right now, we're at a low in terms of values. We do expect it to go up. So if you're an investor looking for conservative returns, right now, real estate might be the right time, specifically multifamily.
And I think we have to look at, I invest a little bit in stock, majority in real estate, but you can find conservatism in each one and higher risk in each one of them. So it's a lot about your appetite. You got to look at your overall market. That's what we love about Phoenix. It's a really stable market overall compared to a lot of different markets in the U.S. So if you're looking for conservative markets for real estate, Arizona's it. You can find general conservative stock markets, stocks that you're looking for, but overall real estate is a tried and true method.
And then there's something that's called correlation. There's a lot of algorithms and analysis you can do to your portfolio, to what your investments are, but you don't want stocks or your investments that are all correlated to the same things. So
Yep.
it's good to have some investments, if you think of it in a few buckets, some buckets of capital that are in the stock market, some buckets that aren't in the stock market, because if one goes down, the other one might go up, or it stays the same.
Yeah.
And that's also called diversification. So those two things, not investing in stuff that's correlated and having some diversification in your portfolio, is what kind of gets you through the hard times like this.
Yeah. Well, we talked a lot about tariffs, but I want to talk about tariffs and its effect on multifamily. So Globe Street came out with an article talking about CRE faces ongoing uncertainty despite temporary tariff pause. And it says in here, businesses and stock traders alike have welcomed President Donald Trump's announcement of a 90-day pause on tariff increases yesterday. However, this temporary reprieve has done little to alleviate the uncertainty surrounding the administration's long-term trade strategy in the market. What effect do you guys think, and I'll just start with Heidi, what effect do you think tariffs right now are going to have on the multifamily market?
Yeah, and I mean, we've talked about this a little before. It's the new builds. It's, money for construction, starting the process from the beginning, maintaining houses, things like that are going to go up in price. Owning real estate, multifamily right now is actually pretty okay. Unless you're planning to do major renovations overall, being in that business is not hard. It's the new builds that are going to really struggle.
Yeah, if you're an operator, you're in good shape right now because supply is dropping off. We already knew that even before the new administration came in. But with all the new policies around tariffs, what's going to happen with the cost to build? The cost of materials is going up because of tariffs. If you own assets, you seem to be in good shape for values going up over the next few years.
Yeah, and we're not renovating our properties at the same pace that we did a few years ago. We're letting stuff ride a little bit longer because the cost to put in new kitchen cabinets, cost to put in new appliances have gone up. So you really have to justify that investment, that you're going to get a return on that investment. And when the cost goes up, the return has to be higher. So right now, we're just operating our projects. There'll be a time where we do want to go renovate, try to push rents. But right now, it's a good time to hold. And then us and other companies, other friends in the industry, rather than build from the ground up, they're buying existing assets, especially because you can get good deals right now on existing assets from folks who are in a distressed situation. Mm-hmm. Or if you're just buying properties right now, even if they're not distressed, you can get better deals than you have been able to in a long time. So the smart investors are buying right now. You have some dry powder to go, and this is the part in the cycle where you want to buy as much as you can, operate it really well, and hold tight until you get out of this bottom part of the cycle.
So another question I have about this is we talk about supply and demand a lot, and there's been so much demand coming out of the market. So if tariffs are reinstated, do you think the multifamily sector will respond by holding back on new supply? So stop, no more building. Or if there's a need to build, will operators just pass along the cost through rent?
Tariffs aren't a big driver of new build. The biggest driver is interest rates. So when interest rates are low, builders get really excited about going and building because they can get their construction loans at low rates. And they know when they go sell the building, the buyer is going to get a good low interest rate. So there's a lot of optimism around building when interest rates are low. That's the biggest driver around new build construction. Right now, interest rates are higher, and that's why you're seeing all of the plans for new builds, they've been frozen and they're on the shelf. When interest rates come back and builders get excited about building again, then they're going to take a hard look at the costs. And if the costs are elevated at that point, then it might not make sense to build yet, even when interest rates come down, because you have to justify what all that expense is with what the rent you're going to get on the back end. So it definitely complicates things. But right now we're way too early to know the impact on all this. And I think this is part of why there's a lot of volatility right now, is we just don't know the rules of the game. And once things kind of cool down and get leveled out, I do think the current administration, they're going to work on tariffs for a while, and then they're going to move on.
Yeah.
So we're in this period of shock and awe, do all this stuff, and negotiate. And I'm hopeful that it ends up being a good thing for our country. We'll see how it plays out, but then they're going to move to their next thing, and then things will settle in. And I think that's what most people are counting on, is that in a month or two there'll be some normalcy to things.
And we always joke, there's no magic 8-ball that can answer the questions about where real estate's going. One of the interesting things, though, is we do know new builds coming onto the market. That's the only thing we can see permits going in for 3 years from now for what's going to be finished. That's the only prediction we have. And we are seeing a slowdown of new builds coming on over the next 3 to 5 years.
Yeah, it's a total cliff.
Yeah.
They've dropped off. Projects that were planned and almost broken ground, they're not doing them anymore. So you're right. That's the data you want to look at, and it's falling off a cliff because we had a ton of building when interest rates were low. They were all planned. So that is something that, as an apartment owner, we watch very closely, and we're expecting that's going to impact our industry a lot as new builds get frozen and they don't come to fruition. Thank you for listening to our podcast, The Multifamily Masterclass. Please subscribe to get all of our new episodes.